Cory says, how do you examine rolling a PMC, a poor man's covered call short position? So long call against short call. Also, when that short call is going in the money to deep in the money, eating the gains, how do you deal with that on or near expiration? Okay. And Cory says, I don't see rollout opportunities when I have that position. We did have some rollout opportunities for a poor man's covered call trade, the diagonal calendar spread, calendar call spread, I should say. But I noticed, Ernie noticed an errant calculation on there, so the programmers are working on that as well. But a lot of times, I think there are still rollout opportunities for the calendar call spread that are shown, both adjusting the long call up if you have a gain on it to cut down the loss and moving the short call as well. Let's stick with our position. Why not? We're on AIG, so we'll just go ahead and go with AIG in this case. And I'm going to go out and let's say when the stock was at around no, we'll say that when the stock was lower, went out to June, and let's say I bought the 52.50 for when the stock was lower. Let's say we bought it for 650. And I sold to open. I know it's not going to look real good because it's probably not the most accurate position. We're going to go ahead and sell the 57 call. I should have used the 50. I'll change that to the 50. We sold the 57 call for 75 cents. Okay. That's pretty good, though. I'll leave that there. It doesn't matter the date. Cory, we'll just leave that in. Let's just put in basics of one contract. All right. So, bought a 52.5 for June, paid $6.50 for it, got 75 cents back. So I have a debit of $5.75 on a strike difference of $4.50. Pretty good. Oh, actually, that's terrible. That's not what I would typically do, but that's all right. Now the position is slightly in the money at 57.48. And this might not be deep in the money enough, so I go to position actions and then position analysis. Don't have a gain on the long. Yeah, okay, so no rollout opportunities came up. That's fine. So if you don't see any rollout opportunities in any strategy, Cory, that you're tracking, and I'll get on the programmers a little bit there, see where we stand with some of those rollout opportunities on the calls here. But what we always typically do is just manually evaluate rolling the position. Tracking any position in my portfolio, whether it's a bull put, whether it's a bear put debit, a calendar call spread here, covered call, naked put. If I don't see any rollout opportunities, I'll just go to the profit and loss chart on the position. Yes, I'm slightly in the money here. It's not too bad in that case. But again, what I'm going to look to do is analyze what would happen if I rolled up to this strike, or, I'm sorry, Cory, if I rolled up the strike in the same expiration, how's that going to affect my position? And at the same time, if I wanted to roll further out, what steps would I go through to analyze that in this position? It'll also apply to doing married puts and simulating rolling a call if you didn't see the rollout opportunities in that dynamic collar spread or a long-term married put with a near-term call sold against it that's now in the money. So first thing I have to simulate here on the profit and loss chart, March 11th, sorry, is buying to close my short calls. Let's go ahead and click on that again. So, oh, sorry, folks. Give me 1 second here. That will help, won't it? All right. Okay. So I see that it's been added, but I want to click it again one more time. It doesn't show me it's added twice, but I want to do that because it's going to appear again, and I want to simulate buying to close this option. Right? So that's just going to leave me what? That's going to leave me the long call now with just an increased cost basis of 716. And oh, let's open this up a little bit more here. Okay, there we go. Now it looks like a calendar in this. I mean, it looks like a skewed long stock position instead of a long call because this system isn't reading that I closed it, Cory. It's actually reading that I am long and short an 11th March 57 and still long the June 52. So it's still looking at the near-term calculation for profit and loss on the 11th of March. We can take care of that pretty simply. I know that the cost basis would be 716.50. So what I can simply do, due to the extra 66 cents or so it's going to cost me to buy back this option, so we go up to a cost basis of 716.50. What I can do now, Corey, is just clear these two out, put in a cost basis of 7, 16 or 716 or 717 if you want to round up. Okay, so what do I have left? Now there's my June call. I've already factored in that we're buying back that short call position and what effect it would have on the new long. Now we can simply take a look at what would happen if I rolled up now that that's taken account into the March 57.50, March 58 for the same expiration. Probably not going to get as much premium. So we'd have bought that back. Was it a 141? And we're going to sell this one, slightly lower price, 94 cents at midpoint. And that gives us the new potential max return at March 11th expiration. But of course, if you need to go ahead, Corey, and you need to go further out in time for the more distinct buyback, especially when you're deeper in the money in this position, now I might look going out 30 days to April 1st. Happy April Fool's Day there, trying to get a little bit more premium, maybe at the 60, a little bit more breadth, a little bit more room here. I've already accounted for the buyback cost into that long option. And now we see here the expected return on the position. Yeah, this is one I'd more likely to be in. How can I tell that? Well, on that first position I entered, which was just a fake trade, just use some fake numbers, of course, we saw that this level here, the upper line, dipped down below into a second way to lose. And that was because the net debit of that fake position I first created was less than the difference in strike prices, which is for me is always a no-no, even when I'm rolling. I always want the total cost basis of what I'm rolling to, and what even I increased maybe the cost basis of my long option by having to buy back the in-the-money short. I always want to make sure that that difference in strike prices, in this case here now, we are at the 52.50 and the 60 strike. So in that case, we've got a 7.5 point difference. Perfect. My debit's at about 567. When your net debit is less than the difference in your strike prices, of course, that means even if the stock suddenly ran up and you were signed early on the short and your broker exercised the long to deliver the short option, you'd still be coming out with some profit. Not the maximum profit. Remember, this maximum return for a calendar call spread is based on if the stock is trading right at your short option strike price at the short option expiration date, based on the theoretical price, the Black-Scholes price of my farther out in the money call if the stock was trading at this price at the short-term expiration. If I allow it to be assigned, if it goes in the money and I don't manage it, I don't roll it, and my short call is assigned, I don't get the remaining time value of this long call. I just get the intrinsic value back. So my return is going to be much less. In this case, it's going to be what? 570, I'm sorry, 750 minus the 566. So we're looking at about $1.90, $1.85 maximum profit, not the 357 that we might still expect with the remaining time value that would still exist on that June option as well. This is one of the reasons, Corey, why I don't like to use the term poor man's covered call. Because many investors who traded covered calls in the past and then say, hey, I want to do a poor man's covered call. I don't want to buy the stock. I want to buy the right to buy the stock at 1/10, 1/8 of the price and still sell calls against it. And a lot of times, some of those investors get into trouble because they don't pay attention to the criteria. And they assume that, well, if the stock is anywhere above my short call strike price, just like a covered call position, I get assigned and make this potential max return that I saw. No, it falls off after that as it starts going deeper and deeper in the money. And the main reason for that, of course, is the reverse delta ratio. When we initially open a diagonal spread, I might have wanted to use the filter in power options to find a delta ratio of greater than maybe, let's say, 1.7 or 1.8. What does that mean? It's the delta of the option that I'm buying divided by the delta of the option that I'm selling. So I want this option to be higher, so as the stock moves up 1 point, I'm gaining 60%, 70% more on my long option than I'm losing on my short. As the stock continues to move up and your sold call goes deeper in the money, the delta, and you get closer to expiration, of course, Corey, that's when the delta ratio shifts. This delta is quickly going to a delta of 1 or 0, depending on where the stock is. If it's deep in the money, it's quickly going to a delta of 1. Meanwhile, even though this option is deeper in the money, it's still out to June. It might be hovering at around 0.8, 0.83, 0.85, somewhere in that range. So now your delta ratio is reversed. You have a delta ratio of less than 1, and this is why you see the profit and loss chart tail off. As the stock continues to go up and your diagonal spread or poor man's covered call goes deeper in the money, that's why you see it trail off, because you're losing more on the short call now as you're closer to expiration with that delta of closer to 1 than we're gaining on our 52.5, which might still be at 0.8, 0.83, 0.85. What does this have to do with your question, Corey? The reason I mention this is because you had asked about rolling the call. And you said, okay, you didn't see the rollout opportunities there. I'll get right on top of that. But you can use the profit and loss chart to simulate the rollout opportunity that you'd want from your position in the portfolio based on where you think the stock's going to go. But why I went through that whole discussion is because you also asked, how do you move the position? How do you, when it goes deep in the money against you and you're giving up a lot of cost to it? Earlier in this presentation, we had discussed about cash secured naked puts, that you don't want to be in the money, that you may want to consider buying to close the option when it reaches within 0.3, 0.5% as you get closer to expiration, or the 1% rule that we use for a bull put credit spread if the stock starts to fall to within 1% of our short put strike price. A different way of approaching it is that with a calendar spread, if the stock starts to move up and your position goes 1% in the money, or even if it starts to reach within 1% out of the money, depending on what your original structure was. I think both Ernie and I tend to use this 1 to 1.5 in the money. That's when we're going to look to roll out the position. I don't want it to go 5% in the money. I don't want it to go 6% in the money. I don't want it to go 10% in the money. I'm going to look to roll it before then, in that case, and to move up that price. I don't want to let it get too far against me, especially if I'm in that structure where the net debit was greater than the difference in strike prices. 7.5 here. Okay, so let's say I paid $7.86 for this, and we only got 36 cents for this. No, I'm sorry, we only got 25 cents. I know you probably wouldn't enter this position. We're just going to use it as an example for a diagonal spread. Debit is $7.61. That's not too bad. You see what happens, you get closer and closer to a loss. Now, you can still make a reasonable profit with this structure. But whenever the net debit is greater than the difference in strike prices, that's when you tend to give yourself 2 ways to lose if it really takes off. If the stock gets assigned in that case, and that's not what I want in the particular position as well. So don't let it go too deep in the money, but if it does go too deep in the money, stay with AIG, but we're going to do something completely different. Probably could never have gotten these prices where AIG has been. In that case, so we'll stick with June. And let's say I bought a 40 for around $7. Let's say when the stock was trading at 45, it hasn't been. This is fake. These are not real prices. This is just an example. And I'm going to sell. We'll sell the 50. We'll do a 10-point spread. And let's say we got 35 cents for it. Now, I know this is not deep in the money. It's more than 10% in the money, right? The stock's at 57. We're at 50. So we're close to 15% in the money here on this position. There we go. Fantastic. Okay. I'm so sorry. I'm in a calendar, not a bull call debit spread. March 11th, we'll just keep with that 50 strike call at 35 cents. Make sure to sell it correctly this time. There we go. All right. So yeah, this is a good return, but now I'm deep in the money on this position. I want to roll this up, but what else do I have here, Corey? You know, I'm going to pay a hefty price to buy this back now for March 11th expiration. I'm going to pay, midpoint of around, what is that, 680? It's almost 7. Oh, it's almost 7, yeah. But at the same time, remember my 40 call, I only paid $7 for, and it's up to about 17. So when this happens, when it goes deep in the money, yes, you want to give a higher strike price. You want to go into the 57.5 range, and that's going to be pretty expensive. But I also might want to sell this 40 call in this case and take the profit on this. Let's just take a look at how this value. Let's add that one back in. Let's go to our June position. Yeah, it's right about almost the same price this deep in the money, right? So what am I going to do? I'm going to buy to close the 50 for that very high price, and I'm going to simulate selling to close the 40. This is just going to simulate, Corey, closing out the position in its entirety. But I'm going to have a credit of $422. If I sell to close the long and have to buy it back, what happened on your position where your short call was so deep in the money? Well, it went up beyond what your expectations were. You've got to pay a hefty price to buy it back. How do you hedge that? Take the profit off the one that's also gained in your favor. You know now you're standing on a profit of $4.22 per contract. In this case, we're just going to keep it at $4.22. We're not going to round it up to $4.23. Now I know where I stand. I know what my liquidation value is. But what I can just simply say is, all right, I want to stay in June. Now the stock's at 57. I'm going to go up to the 50 call. It's going to cost me $920. I just simulated buying everything back. Let's go out another week to March 18th and sell maybe that 58 call for 107. Okay, let's just put it at 140 and 940. I'm going to put it at 942. All right. That looks like a pretty good trade, doesn't it? But because, what am I forgetting? I can drop this down to 520. This accounts for that 422 profit I got by essentially one. You're not really doing it this way, but what you're looking at, Corey, is you're liquidating that one position, taking the gain you have in that long call, which should hopefully be pretty close. If not, it should be higher than the loss you're taking on the short call in that case. And now I've got a pretty strong position with a debit of 380 from the profit I took on the original position that's applied to the cost basis. That 422 is applied to the cost basis of 942 for our June 50 call. We've rolled that from the 40 to the 50, and we rolled our short call up to 58. We still lowered our exposure to the downside, increased upside potential profit by rolling both legs, not just the short. If the short you feel is too expensive to buy back and it's too expensive to roll because it got away from you, it happens, I know. Take a look at that long. That's also an asset you have. Use that to your advantage. Cut down the cost basis of the buyback for your in-the-money short call. Move up the long call as well. Of course, you still have to be bullish, essentially neutral to bullish on the structure to roll that long call up, but it's a good way of doing it as well. And Corey adds on that, so you don't stare at the screen and hope for reversal before eventually closing. Same topic that we discussed about earlier with the naked put for Mike and the video that we referenced from 2 weeks ago. Can a spread or sold option end up in the money after hours? Sorry, I don't have the time, honestly, on Friday at the close. Typically, now we only got Mike's email came in, but it came in late, so I didn't have a chance to put in any slides. But typically for Friday discussions, I might get as many as 3 or 4 emails that come in starting at about 2:30 or 3 o'clock of questions that attendees are going to have. I'm spending my time putting slides together for the Friday presentation coming into Friday's close. I've already closed or managed the bull put credit spreads I have come up. Management also includes rolling. I would have already rolled any calls that were likely expiring or were in the money coming up to expiration for the married put positions if they were in the money. If any of my short puts, again, as I mentioned, were within 0.3 or 0.5% of my short put strike price, I probably would already have been closing them, and I'm not watching it on Friday. I don't have that advantage. And Ernie sometimes is on coaching sessions on Friday afternoons, so he doesn't have the time to do that as well. So, yes, for me personally, I tend to have already closed, rolled, or managed my positions by 1:30 or 2 o'clock on Friday instead of watching it to the last minute And again, those other rules that we applied to some of those other positions, when my triggers are hit, it's part of your trading plan, Corey. If I don't want to let it go in the money, or on my bull put credit spreads, I don't want to risk that short put going in the money. If it reaches within 1% prior to expiration, which again happened to me on 2 of the last 5 bull puts I did, and happened to be on the new one for the next cycle on the 18th, I've already managed the position rather for waiting for next Friday or wait to see what happens the next week, following this distinct trading plan to move forward as well. On this note, Fernando says an alternative to buy a stock is to buy an ITM call with 0.7 delta far in time. Now, that is what Cory was doing here with the calendar spreads and the poor man's covered call. Fernando, I'm not sure if your discussion was related to the stock position and the covered call discussion we were having earlier for John's question that had come in or not. So I'm just mentioning that there. That is the poor man's covered call, the diagonal spread. I'm sure Cory was using a delta maybe of 0.7, 0.8 for the buy, of course. And that's typically what we look for. And I keep saying what we look for. What do I mean by that? And that's the default criteria that we prefer to use for the calendar call strategy. Let's just remove long caller for now. I'm going to go into calendar call spread. Let's save that configuration. And let's go into search. All right, and this is calendar leaps number 1. My preference is to use the initial values default search, and then I'll make adjustments to the time frame. Maybe I'll just put this down to 115 to 400, let's say. And oh yeah, this is going to 25, 22, 23 days out in time. Everything else here is fine, and I may adjust this. I don't want to maybe start off with more than 4 or 5% out of the money. And oh, sorry, delta, yes. Usually maybe 0.7 to 0.75. Delta ratio, 1.8. I've been lowering the delta ratio just with all the implied volatility and shifts that have been going on in the market in shorter term. And of course, my debit to strike difference ratio is less than 1. There you go, okay. So yeah, that's 65 call on Oracle, 76.49 using the 79 strike. Wheaton's, I like this structure a little bit better. Not the price, not the return, but doing a July 40 WPM against a 48 strike. This will lead into maybe Jerry's question in just a moment, looking at that one as well. So with other criteria, you see there are not many results. It's mostly dominated right now by Wheaton Precious Metals. I'm going to say silver Wheaton to the day I die because it's one of the first positions I ever entered, and Oracle as well. And that's because the other stock criteria that are in here for this structure aren't being met right now with recent market conditions, because it is a neutral to bullish strategy, and I want to use neutral to bullish stocks as well. I had mentioned earlier in the presentation, this is a follow-up for Cory. I mentioned earlier in the presentation that, part of the PowerOptions tools, what we do here is that you can search and scan across the universe of options to find positions that match your specific criteria. There's a lot of calendar option criteria here, but in any search, in addition to screening for what you'd like to see maybe for implied volatility ranges or percent IV ranges, net debit, downside protection, maximum percentage return, annualized return, range in or out of the money for the long or short options, delta ratios, debit to strike difference ratios, Black-Scholes ratios, spread width, so on and so forth, volume open interest. You can also scan by a variety of stock technicals. I could look for maybe a stock to be trading above the SMA 20, SMA 30. We have some defaults in here. I can use MACD, Bollinger Bands. Also, of course, using stock fundamentals, looking for stocks with positive earnings per share growth, good PE ratio, and an earnings date not between now and expiration. You can see the exact criteria that are being used for each search down here below the listed criteria, and you can enter in any criteria you want for fundamentals or stock technicals to find positions that are neutral to bullish ranges for the desired strategy, bearish ranges for the desired strategy, completely neutral, more or less, if you're looking for iron condors, maybe an iron butterfly, Cory, something along those lines. And so our defaults do take that into account in various strategies. Let's just go to a default covered call search very quickly. That's one we created on the fly. This is in the default. We were looking for stocks above the 20-day moving average and a positive MACD crossover of at least 1 day. Similar criteria are used for our preferred bull put credit spread screens as well. Not saying that they've been all that successful because the market hasn't exactly been neutral to bullish, but that's what we look for in these positions. Cory, I'm going to go ahead and say my answer is no, but that doesn't mean it's right. It's just not the way I approach it. Cory says, do you ever buy the stock or leap and wait for an uptrend to sell the short for higher premium? Okay, I lied. I do that, but in a completely different strategy. When I've decided to use a calendar spread in my portion of the portfolio, I'm doing the positions that match the criteria that I want at once. Just like when I do a bull put credit spread, I do the positions that match my criteria when I run the search. That's me personally. Now, of course, I may be rolling this position. I may be moving it up. Now, the one position, and there's nothing wrong with doing that if you have the confidence, Cory, that the stock is going to move up in that case. Okay? The one structure I will do that on, of course, is the married put, following the rules in the blueprint. The married put is a structure where I am buying the stock, but I'm buying a far out in time, 150, maybe 200 day out put option that's slightly in the money to keep a controlled risk of only about 3 to 7% on the position. I'm buying the far out in time option, so I have time on my side because of the time decay curve. I don't start to really see any decay on that option. Yes, I'm paying a higher price, but if I buy a 1 month output, then I have to buy another 1 month output and then another 1 month output. I'm going to pay a higher annualized cost. I get a lower annualized cost and I keep time on my side for the first portion of the position. In this case, yes, now I'm going to wait for the stock to move up 3, 4, 5% and then look to sell a call to create something that looks like the calendar spread we were just viewing, because it essentially is a calendar collar. I might have a June or July put, as I do on AIG. Remind me to show you that in 1 second. I have that put, a 65 put against my stock position, and if I sold the call near term, we'd see sort of that same similar calendar spread, but in this case now my risk is only controlled to about 4% in the worst case scenario of what I have invested the position, still probably being able to make 3% in that near 2 to 3 week time frame, and still some profit up here as well. That's how I approach that. Okay. Yeah, and Jerry, this goes back to your question as well. Absolutely, a bullish strategy. Oil and gas, Mary put, if and only if you think oil and gas will continue this bullish rise, it's highly possible. What are you thinking for the next 3 or 4 months? It's not a short-term position. The Mary put is a longer term, so you'd want to still have that same bullish outlook. It may, hopefully, knock on wood, pull back at some point in the next month and a half or 2 months, of course, and then you'd want to readjust your positions. But yes, if you're bullish, shorter term, any bullish strategy works. All right. So in that case, Cory, I will. But usually what I've made the commitment to a diagonal calendar spread, and my approach is not your approach. There's nothing wrong with looking at what you're doing. I've just been wrong too many times trying to leg into a position. And this market right now is a little bit too volatile to have confidence very strongly in one direction or the other for an extended period, in my opinion. So I still use the calendar spreads for stocks that are neutral bullish. And the main use, of diagonal calendar spreads in this position is that I'm likely trading at a higher price stock that I can't afford to do with a married put in my portfolio, while still keeping risk controlled. It's a known risk, but I'm only doing smaller contracts. So the risk in a diagonal spread, if it moves completely against me, and I lose 70 to 80% on that calendar spread, which is a possibility. If there's a larger market downturn or sudden market movement, that's only going to represent 1 or 2% of my total portfolio. Proper position sizing, which the married put forces us into, which for Jerry, that would be a good approach, obviously, because if the oil starts to ease up and it starts to pull back faster than you expected, you know you have an extremely controlled risk in place. And again, you probably won't see many of those stocks using our default married put search because we're looking for the specific rules that follow in the blueprint. And the blueprint also contains the 12 different income methods that we're going to use to adjust the position to get that to bulletproof status, lower the risk further, and still increase the potential profits as well. But you could change the criteria just as I showed. You could change it to just look for technicals and remove any of the lists there. And those technicals that match that with the risk control you want, Jerry, will be right there for you in the search tool for married put positions as well.